Welcome to the debate on breaking news to trading moves. Imagine an entrepreneur who is so terrified of losing their startup capital that they never actually sell a single product.
Right. Just staring at a full bank account.
Exactly. Just sitting in an empty office, meticulously reviewing the budget and calling themselves a business owner. But in the financial markets, traders do exactly this every single day. We talk endlessly about protecting capital, but there is this precarious boundary where sensible caution turns into, well, complete paralysis.
Yeah, because risk is the mandatory entry fee. I mean, you cannot run an enterprise without exposing capital to the elements. The bank account might stay full for a while, but you are not operating a business at all. You are just managing a very tense, very demanding savings account.
And that exact tension is what we are debating today. We are exploring the boundary between protecting capital and taking the necessary risks to actually participate in the markets. The central question we have to resolve is this. At what point does responsible risk management cross the line and become detrimental risk avoidance?
Which happens a lot more than people admit.
Oh, absolutely. So I will argue that prioritizing absolute capital protection and waiting for stringent confirmation is a rational, professional necessity, especially in a market devoid of certainty. Because, well, unmanaged risk is the ultimate danger.
And my position is that this extreme caution is almost always just fear disguised as discipline. Demanding complete confidence keeps a trader permanently on the sidelines. It guarantees the failure of their strategy by mathematically destroying their edge.
Okay, let me outline the foundation of my perspective first. Protecting capital is the absolute most crucial principle in any market endeavor, period. Survival comes first.
Sure, survival. But at what cost?
The cost of waiting. The reason I defend extreme caution, even if it means sitting on the sidelines for extended periods, is that the market never offers certainty. No setup is guaranteed.
That is true.
Right. Even your strongest, most tested pattern can fail without any warning. Because the environment is inherently unpredictable. Waiting for perfect confirmation and, strictly reducing position size when conditions feel opaque is the armor of a professional.
Okay. But
let me just finish this thought. Unmanaged risk, oversizing, and emotional trading are the literal dangers that destroy accounts. Staying out of the market protects the account from immediate drawdowns. It preserves the financial and mental capital required to trade another day.
I will play devil's advocate to that framing. That interpretation takes the concept of discipline and, quite frankly, weaponizes it to avoid the uncomfortable reality of trading.
Weaponizes it?
Yes, weaponizes. Because trading requires capital to be exposed before it can produce a return. By validating extreme caution, you are validating behaviors that destroy a trader's mathematical advantage.
I don't see it as destroying the advantage at all.
But it does. Reducing size until the reward is meaningless, waiting for endless extra confirmation, rejecting valid trades just because the previous one lost, those behaviors are not professional risk management. They reveal a fear of being wrong.
They are protecting the downside.
No. Risk is simply the cost of participation. A properly sized loss taken according to a tested plan is an expected business expense. If you demand complete confidence before taking risk, you guarantee zero returns.
You say it destroys the mathematical advantage, but let's look at the mechanics of a chaotic environment. If we accept the premise that certainty does not exist in trading, then it logically follows that a professional should demand extra confirmation.
Extra confirmation just means a late entry.
Not necessarily. Think about a retail business facing unpredictable economic conditions. If the economy is volatile, withholding capital, choosing not to buy excess inventory, is standard, prudent practice.
Right.
Why should trading be any different? I mean, if my strongest pattern can fail, why shouldn't I wait for one more technical indicator to align before I risk my capital?
Because by waiting for that extra confirmation, you are entering the trade far too late. You are entirely ruining the risk-to-reward ratio that gave your strategy an edge in the first place.
I wouldn't say ruining.
It is ruining it. Let's break down the math. Let's say your edge relies on winning 4 out of 10 trades with a 3-to-1 reward ratio.
Okay, standard setup.
Right. Those 4 winners pay for the 6 losers and leave you with a profit. If you wait for extra confirmation on a setup, you enter at a worse price. Your stop loss has to be wider.
Sure, your stop is wider, but
And suddenly, your 3-to-1 reward ratio drops to 1-to-1. You aren't just protecting the downside. You are structurally breaking the math of your business model. You are seeking a feeling of safety, not a mathematical advantage.
you are assuming the trader will capture that 3-to-1 reward if they just jump in blindly. I argue that waiting for confirmation filters out the lower probability trades.
Does it, though?
Yes, you might get a worse entry, but your win rate goes up because you avoided the false signals.
The data rarely supports that. Professional trading is about accepting uncertainty while limiting the damage when you are wrong. It is not about eliminating uncertainty.
I never said eliminate.
But waiting for perfect indicators is trying to eliminate it. You need a reason to enter, a defined exit, and a rational position size. Once those 3 parameters are met, hesitation is no longer caution, it is avoidance.
Avoidance of unnecessary losses.
If a retail store refuses to put any inventory on the shelves because they demand a guarantee that customers will buy it, the store goes bankrupt by default. They have 0 revenue. Demanding complete confidence is just a stalling tactic.
Hold on, let's follow that logic. If we agree that a trader shouldn't blindly jump into the market, and we agree they shouldn't stall indefinitely, how do we actually tell the difference between healthy discipline and this paralyzing fear?
It is actually quite simple.
From my view, avoiding a trade often prevents a cascade of poor decisions, especially after a losing streak.
There is a brilliant diagnostic question we can use to separate process from emotion here. Before skipping a valid setup, the trader must ask themselves, am I avoiding this trade because it violates my rules or because I do not want to experience another loss?
That is a tough question to answer honestly in the moment.
It is, but it is entirely necessary. If the setup does not meet your criteria, avoiding it is discipline. But if it meets your criteria and your heart rate spikes and you still cannot pull the trigger, the problem is emotional fear. You are destroying your own edge because you are terrified of the outcome.
You are completely dismissing the psychological reality of the human being pressing the buttons. Let's examine what actually happens in the brain.
I know what happens in the brain, but
When a trader takes a loss, the amygdala treats that financial loss exactly like a physical threat. The biological response is self-preservation.
right, fight or flight.
Exactly. If a trader just took 3 losses in a row, their judgment is compromised. Avoiding the next setup might be a highly rational way to prevent a total emotional spiral.
I acknowledge the biological response, but yielding to it is exactly how the fear wins.
Have you considered that feeling relieved when a setup disappears is just a biological safety mechanism? If taking the trade would cause outright panic, stepping away is the responsible choice to protect the account from a meltdown.
Yes, the relief of a disappearing setup is a natural human response, but professional execution requires operating counter to natural human responses.
Which is incredibly difficult.
Of course it is. But if you reject a perfectly valid trade today because yesterday's trade lost, you are treating independent statistical events as if they are connected. They are not.
They are connected in the trader's mind.
A setup meeting your criteria is a valid business opportunity. Skipping it because of a prior loss is not discipline. It is allowing past trauma to dictate present execution.
I am not convinced by that because you are treating the trader like a line of code.
I am treating them like a professional.
They aren't an execution algorithm that operates in a vacuum. Human capital, the mental stamina required to operate in the markets, is finite.
That is true. It is finite.
A trader operating under the cumulative stress of recent losses is highly prone to reckless decisions. Moving stop losses, revenge trading, doubling down.
Which is bad, yes.
Therefore, stepping back, pausing, and waiting for absolute clarity is a defensive strategy that serves the ultimate goal, staying in the game. You cannot execute a statistical edge if your account balance drops to 0 because you forced yourself to participate when you were psychologically compromised.
I agree that you cannot execute if your account is at 0. But avoiding every trade trades a sudden death for a slow death by attrition.
Slow death.
Yes. You protect your account from short-term losses, but you guarantee your strategy cannot produce returns. You are bleeding out to inflation and opportunity cost for the perceived safety of not having to face the market.
But look at the mechanical reality of trying to force execution when a trader is paralyzed. If safety is the priority, how does a trader mechanically reintegrate without blowing up?
They size down.
Exactly. The analytical framework we are discussing advises traders to start with a position size small enough to follow the plan without panic. This slow, highly controlled, cautious reintegration proves my point perfectly.
How so?
Capital protection remains the governing law. You scale down the risk until the fear subsides.
I agree with scaling down, but there's a crucial caveat that often gets ignored there.
Which is?
The size must be small enough to follow the plan without panic, but it must remain large enough for the outcome to matter.
To matter to whom?
To the trader. I mean, if you reduce your position size so much that the potential reward feels meaningless, you are not actually trading. You are just pretending.
It is practice, though. It builds the physical muscle.
It is a simulation. It does not bridge the gap between theory and reality.
But scaling down reduces the emotional friction. It allows the trader to practice the physical habit of execution without the paralyzing fear of ruin.
But
if risking $10 instead of $1,000 gets them to click the mouse, they are rebuilding the habit.
execution is meaningless if the math doesn't matter. This brings us to a specific mechanical solution that I think is mandatory: the minimum participation rule.
Okay, explain that.
Think of it like exposure therapy for a phobia. You don't cure a fear of heights by jumping out of an airplane on day one. You stand on the first rung of a ladder.
Sure.
The minimum participation rule says that if a setup meets every single condition in your plan, you must take it at a predetermined reduced size. You have to stand on the first rung of the ladder. This forces execution and prevents fear from rewriting your strategy in real time.
I had to stop you there because the minimum participation rule has a massive flaw.
What flaw?
What if standing on that first rung causes a panic attack that makes them kick the ladder out entirely?
It's a small size. They shouldn't panic.
But if a trader implements a mandatory participation rule before they have resolved their underlying fear, they might execute the entry perfectly, but 5 minutes later, the anxiety spikes and they instantly break their rules on trade management.
That is a risk, yes.
They exit prematurely, or worse, they move their stop loss to avoid taking the hit. By demanding participation, you are forcing a compromised trader into a live environment where their emotions will cause them to break the rest of their plan.
So what is the alternative?
A cautious pause, stepping completely away from the screens to review the strategy, is far safer.
Safety is not the ultimate objective. Controlled exposure is. The goal of risk management is to help you participate consistently, not keep you permanently safe on the sidelines.
It is hard to participate if you blow up your account.
If you step away every time you feel apprehension, you will never learn how to execute while feeling apprehension. And since the market never offers certainty, you will always feel some level of apprehension.
True, there is always some apprehension.
The minimum participation rule is vital precisely because it forces you to face the discomfort. You take the trade at a reduced size to prove to your amygdala that the world does not end when you enter the market.
Right, exposure.
You take the loss, you see that it was just a calculated business expense, and you move on to the next setup in the series.
The premise of the series is a mathematical necessity. Judging a strategy over a sequence of 50 trades rather than a single outcome is how an edge is realized.
Exactly.
But I maintain that prioritizing the protection of capital from emotional spirals remains the absolute foundation of longevity. You said earlier that extreme caution trades a sudden death for a slow death by attrition.
I did.
I argue that given the choice between a slow, stagnant account and a ruined account, stagnation is always the superior option.
Really?
Yes, you can always recover from stagnation. You cannot recover from zero. A cautious pause preserves the capital for when the trader's mental state and the market conditions finally align.
But that perfect alignment is a fantasy. It does not exist. Controlled exposure is mandatory because risk is the necessary cost of participation.
It is a cost, yes.
If you avoid the cost entirely, you forfeit the reward entirely. When protection becomes the main objective, growth becomes mathematically impossible. Stagnation in a financial market is just ruin playing out in slow motion. Avoidance ensures you never realize the edge you work so hard to build.
Yet, looking at the mechanics of everything we have discussed, there are clear points of convergence in our perspectives.
We both agree on the premise that strong, professional traders are not fearless.
Oh, absolutely not fearless.
They experience the exact same biological and psychological pressures as anyone else.
Absolutely. Their advantage comes from taking calculated risk repeatedly despite the fear, not from an absence of fear. We also agree that uncertainty, drawdowns, and losing trades are completely unavoidable realities of the profession.
Right, they are the cost of doing business. And we agree that the ultimate goal for any market participant is a defined exit and a rational position size.
Yes.
The mechanics of risk management, knowing exactly where you will get out and how much it will cost, must be mathematically defined before a single dollar of capital is ever exposed.
Exactly. Capital should be relentlessly protected from reckless decisions, but it must also be decisively deployed when an edge appears. It is a dual mandate, and failing at either one leads to failure of the enterprise.
It is an ongoing, daily challenge to find that exact line between process and emotion, between discipline and paralyzing fear. It is a philosophical divide between the cold mathematics of an edge and the complex psychology of survival.
It really is.
For those listening, I suggest examining your own missed trades over the last month. Look at the setups you skipped.
Yeah, use the diagnostic framework. Ask yourself a hard question. Were you practicing true discipline by avoiding a rule violation? Or were you merely avoiding the reality of risk because you didn't want to experience the biological pain of a loss?
It forces a very honest assessment of your operations. Are you building a resilient business in the markets, taking calculated, defined risks to capture a return? Or are you just sitting in an empty office meticulously guarding your runway, operating a very tense savings account while the opportunities pass you by?
That is the complex reality every participant has to navigate.
Thank you for joining us on The Debate. Until next time,